Good morning, everyone. Thank you for joining us today on our webinar, Equity Investing in Today's Context. We are waiting for a couple more people to join in, so we'll begin in another 5 minutes.
Can start, right?
Good morning, everyone. Thank you for joining us today on our webinar, Equity Investing in Today's Context. Today, we have with us Mr. Jia Balaji, who's the Head of Research and Co-Fund Manager, and also Mr. Ganesh, who is the AVP of PMS. I invite them to begin the session.
Okay. Thanks, Poonam. Good morning to all. Thanks for joining us in a Saturday morning. The idea behind today's webinar is to share the context of where are we in the market, both from economic development, corporate India commentary, and then how are we positioned in a couple of our funds, right, in terms of what's our philosophy and the way forward. So the first part I'll run through in terms of how the economic landscape currently. To start with, let's talk about the RBI policy, which is, in our view, it's a very important policy which just happened a couple of weeks back. Moving on to next slide, a very interesting development happened in the last policy where RBI finally paused the rate hike. In the last full cycle, RBI has increased to 250 basis point of a repo. And finally, markets were expecting a little more hike, but given the current consideration of how much hike has been gone in and their effect and the incremental growth expectation, I think RBI, in our view, rightly paused the rate vis-a-vis the expectation, which is a big pivoting point in our view, even though governor clearly stated it's a pause rather than a pivot. But we believe it's an important development to keep considering for any capital allocator with a 3-4 years perspective. So cumulatively, if you see the overall effective rate hike is 290 basis because the reverse repo also moved by 40 up. So close to 290 was an effective rate. Significant movement of policy rate has been happened, which I think over the next 5-6 months will play out in the economy. That's where the governor paused rightly. The both two important metrics, which is going to be importantly watched. One is growth and the inflation, and in the subsequent 2 slides, we will share on why did RBI did what they did. And the monitorables from a policy point is 4 variables in our view. One is monsoon. In next 90 days, it will play a very important role. The initial expectation of this monsoon going to be a little more weaker than what broad expectations were. But I think we have adequate reserves, so it should be okay. But we have to be data dependent. That's what even governor said. Crude, it's been a little more benign than what last year. The similar time last year, the crude was close to $110 because of spike on post-Ukraine war. Today, we are trading between $85 roundabout, right? $80 to $85, which is much better. Obviously, $70 would have been the preferred one, but I don't think we have a choice. INR has been behaving pretty comfortable in the last couple of months. I think we have stabilized a lot. Our forex reserve is close to $600 billion. It's been pretty stable. And I think economic growth also, right? I think even though the world is facing an acute short of growth, I think India has been one of the very, very robust economy. I think we will be growing slightly lower than what the initial projection, but still a very healthy around 6 to 6.5% growth based on which projection you are going to buy. Moving on to the next slide, a very interesting perspective in terms of how RBI sees this data and how we also keep capturing is how is the CPI inflation forecast is been panning over the last couple of quarters and how the growth forecast. So let me run through the inflation forecast. To start with, FY23 inflation was expected to be 4.5%. And repo was at 4, right? So slightly the policy rate was behind the forward-looking, rate, this one expectation. But if you see steadily post the war, what happened, right? The expectation started moving very fast. Right? It mean abruptly moved from 4.5 to 5.7 to 6.7, right? I think this is where a lot of people got off guard in terms of, and that was for right reason, right? Nobody anticipated a war. And obviously, on top of it, what we do to solve the war is a subsequent question, right? So, which is actually a close to 220 basis point of elevated rise in the inflation expectation. So RBI started quickly acting on it, moved the policy from 4 to 6.5% in this entire interim course of a year. Now, if you see, steadily we stabilize around 6.5 roundabout, right? 670, and now we are talking about 650, and current next 1 year forward, which is FY24. Broadly, we are talking about 5.2. So the important thing is, unlike like a Western economy where they all never had an inflation for a decade and then they got a shock of 5, 6, 7, 10% inflation. We never gone through that path, right? So I think post-pandemic way the economy got handled was pretty brilliant. That's where our inflation is not crossing like other economies. And for us, a 5% inflation was generally a norm, right? In the last 10 years, we have been seeing multiple cycles of 4-5% inflation. We have seen even a double-digit inflation during our 12-13 cycle, right? So for an Indian society, this is not a very alarming concern, but still, as a policy, our endeavor is to have 4% inflation plus or minus 2, right? So I think our governor attempt and the policy attempt is to get this inflation close to 4. I think the journey is in the right path. Maybe it will take some more time. So I think inflation is inching towards the right direction. The biggest risk to inflation today is the monsoon, which we have to monitor for next 90 days, which will give us a little more. But on a durable basis, I think we are not in a bad shape relative to the world. Coming to growth again, right? So one, inflation is turning slightly favorable, not big time. Coming to growth, again, we started with 7.8 as a projection for FY23 when we were in FY22. And slowly, right, similar, right? Once your purchasing power went off, you have to revise your GDP downwards because people will not be able to buy the same goods, right? Which was prevailing. So GDP got revised steadily and to close to 6.8, and we slightly inched close to 7, right, when we ended. So the broad idea is, again, GDP got revised downward. And if you see the next FY24, our GDP growth is 6.5, which is real GDP. With a 4 to 5% inflation, India nominal GDP should be 11 to 12%, right? But we are very healthy at 6.5 in the context of a world which is expected to do anywhere between 2.5 to 2.8. But broadly, slightly slowing growth. That's where RBI thought it's very important. The forward-looking metric of inflation is not very concerning. At the same time, growth slightly coming off from a high growth, which was primarily due to post-COVID recovery, right? So this both allowed RBI to take a pause. And I think it's a very favorable development from a capital allocation point of view. Moving on to the next slide. Again, similar data, little more elaboration on how RBI thinks about policy rate is something called trailing, 1 year forward real yield, right? So today, the current repo policy at 6.5 and 1 year forward expectation is 5.2. So basically, we already are into real yield of 1.3, right? If this policy were to hold good. So before COVID also, the policy was somewhere close to 2%, right, real. And we went to negative as high as like -1, -2. And then now we are come back to positive. So clearly, I think now policy is ahead of the inflation, which is a good news. So from a tightening cycle point as a house, we strongly believe we are reasonably close to the end of our tightening cycle. And now the debate is how long they will stay here and then go down. That's for topic for another day. But for a good message is, I think from a bond market point, the elevated high interest rates has been done. From here, it will be a pause and maybe over a period, it can be a little more lower. That's what our base assumption. What can change this assumption? One, we continue to have a very sticky inflation and then the war gets escalated. These are data dependent. But as we see, I think this is where I think India stands very good from a policy standpoint. And we are seeing a couple of other central banks across the emerging nation is also pausing, which is also clearly reflecting where, just in case like in Indonesia, where they've also paused the policy rate for last 2 meetings, which clearly reflects for them also, right? The macro is stable. The inflation is not out of the control like a Western world. And their central banks are taking a call about keeping the policy rates benign so that the economy continue to expand, which is also needed from a economy which is about to grow. Moving on to next. Having seen the policy, right, again, it's very important. I'm a continued believer for any long-term allocator of capital, right? We have to continually monitor one development, which is corporate India, and no better season, right? Just now, few of the corporates have declared their updates and 1 or 2 results have come out. So we just touch upon it quickly. Moving on to the next slide, the largest bank, the HDFC Bank have reported the update. By end of the day, they will come with the results, but broadly, they are growing at 16-17%. To put in context, India GDP expected to grow or have grown between 11-12. The largest bank growing at 17-18% on the top line, which clearly reflects they're gaining market share. And even if you see deposit, that's where the biggest pain for a lot of banks. The largest banks have grown 20%, right? Clearly reflects large banks are doing very well. What a day where yesterday evening JP Morgan have delivered the numbers, robust numbers. Clearly, the large banks, even globally, have been gaining market share in a tough market environment. Moving on next, having seen the large bank, how they have done, this is obviously right. Titan, again, a large jewelry, come watch, come retail company. Primarily, Titan is a play on high-end, or the upward market in terms of both from a customer point and the urban point, and a very robust set of numbers again come out from Titan, right? Again, globally also, if you have to see companies like Louis Vuitton have reported of fantastic numbers, and their entire market cap have crossed $500 billion. Clearly reflects there is definitely a portion of the economies, both in India and the Western world, also doing pretty well. And this also reflects how the larger companies are positioned. Because one of the broad, I would not say a myth, but a misconception is large company doesn't grow, but the data reveals otherwise also, right? There are definitely a few large companies are growing much better than India GDP, and there are few companies are not growing at that pace. Moving on to next, a big trend happening out there. This is on real estate, right? Because real estate is one of the very capital intensive industry, very labor intensive. Post after agriculture, I think there's one industry where a lot of labor get involved. And once real estate picks up, right, think about what happens to cement, steel. So it has a huge multiplier effect. And India as a country has gone through a huge consolidation cycle or a down cycle in real estate for last 7-8 years, and last 1-2 years vividly we are seeing that evidence about finally real estate trend looks positive. We have to see how it can sustain, but let's see the facts what they have reported. So this is Puravankara. One of the highlights which we want to show is achieved highest ever annual and quarterly sales, right? So clearly it's not only Puravankara. If move on to next slide, right, where it's SOBHA. In the positive economic environment, SOBHA has achieved the highest ever annual sales, right? Similar commentary. Now we go to Godrej, right? The one of the largest peer set of the in the real estate, highest ever quarterly and annual sales. So what we're clearly seeing is there is definitely strong economic activity happening around real estate, and its spillover effect will be seen over a medium term. And one way to capture a fantastically this is, right, if you see any large private or a PSU bank, 30, 40, 50% of the book will be lending into the real estate or the commercial real estate, right? So clearly this progress on the demand side will still have a multiplier effect on the entire economy and as well as in the markets, right? So case to be a little more positive. Moving on to next. One result which has come last week, obviously INFI came day before yesterday. Obviously, right, market has their own expectation. The broad idea is these are fantastic business, because if you look at any IT company, right, I keep thinking about these business don't need any capital and they continue to generate 100% free cash flow. And just to put in perspective, TCS have 42,000 crores of net profit, and they have paid out 45,000 crores to the shareholders, right? Technically, they have paid out 3,000 crores more than what they have actually earned during the last year. So the payout ratio is more than 100%. So typically, you will end up finding all this business growing between 8 to 10% based on which cycle, with full free cash flow paid out to the investors. So they're a fantastic company. Obviously, they are not going to grow at a rate of 15-20% because they're primarily a growth on world GDP. World GDP is doing between 2 to 3%, and these companies are growing between 8 to 9%. Clearly reflects they're gaining market share, and I think rightly so, right? They are priced well. So I think corporate India started delivering numbers. I think this is an initial phase. I think over the next 2 weeks later, when we do the session, we'll have much more data to talk about how corporate India is delivering. Looking at the growth numbers, right? So we have seen how RBI is going to help the growth. Second, we have seen how corporate India has given a glimpse of what to expect in the next 30 days. We will see how India is doing, right? Finally, moving on to the next slide. This is on high frequency data on the personal side. If you see personal loan growth, right, very robust, around 20%, right? If the economy is not doing good, why would people will be borrowing at that rate, right? If you look at four-wheeler, very clearly reflecting a strong growth. Two-wheeler is mixed bag. Obviously, rural economy is not in that great shape, I think, but that's a next sort of opportunity next 18 months. That's also getting reflected in consumer durables. But service PMI consistently above 55 to 60, right, clearly reflects our economy is in a good shape. Moving on to next slide, which is on the industry side. So consumers are in decent shape. Definitely urban is doing better than rural. The top end of the consumer is doing better than the lower end. But I think this is bound to happen when the recovery is being patchy. But if you look at from industrial activity also, right, the credit is growing between 15, 16, 17%. Again, right, a healthy credit growth. Diesel consumption is close to double digit, right? If economic activity is not there, why would this well happen? Manufacturing PMI consistently above 55, 56, and capacity utilization finally coming close to 75. So basically, India is extremely well positioned both from a banking from growth, banking balance sheet, banking growth, and from the corporate side also, right? So I think the long-term drivers are very, very well in place. Who has a capital next 3-4 years, right? I think this could be a very good phase from investing and then obviously eventually reaping over a period of time. Valuation, right? Finally, right? I think 18 months back, market hit the similar level, and I think there were a lot of enthusiasm, but markets were expensive. I think last 18 months, what has happened is market just consolidated, and we believe this consolidation has given a fantastic window in terms of one, valuations have come in very, very palatable. Second, one of the headwind during the last 18 months was the policy rate hike, right? So you have cost of equity was going up because of the policy rate. And now I started off this meeting saying, right, finally, eventually, RBI looks like trying to pivot, maybe a little longer, but directionally, they're not applying more brakes on economic growth, which is a positive from equity point. Coming from valuation also, right? This is a fantastic slide on the left side. If you see 12th October 21, the markets hit 18,000. But if you impliedly see 1 year forward was 27 times, which is giving only 3.5% equity risk premium. It means by taking an equity risk, the actual premium you're getting is 3.5%, which is one of the lowest in terms of over a period. It should be close to 4.6 to 4.7, and 3.6 means you are basically 1% lower than what the premium was. Market keep hitting 18,000, but if you see steadily, right, market is at the same level, but slowly one forward PEs have come down from 27 to 18 because corporate India have delivered fantastic number during last year, right? So what happened? Your valuations have come down. Even if you go to equity risk premium, adjusting the bond yields, today we are much, much better by 140 basis. So clearly, again, pointing to the same thing, markets are getting a little more palatable from valuation than what 18 months back. If at all you have to be bullish, you have to be bullish now rather than what was 18 months back, right? So that's our broad perspective. Not only this data point, look at price to book on a long-term basis. We are fairly trading at a similar level. Again, it is not the cheapest market, definitely, right? There could be pockets of cheapness, as I tell, right? There is always a bull run happening somewhere and a bear run happening somewhere. As a portfolio manager, our job is to allocate good asset at right price. But at the aggregate level also, market is little more palatable than what 18 months. That gives a great window. This entire year, according to our view, could be a very good year from investing point. And I think next 3-4 years should be the phase where you're going to get rewarded in a handsome manner. Moving on to next. IT, right? Again, obviously, right, with INFI results, it's going to have its, the expectation was very elevated. But one thing we need to understand is the aggregate yield of the market is today 1.4%. And if you were to see IT, right, it's already trading between 3.5 to 4 because during the first half the decade of this last decade, right, IT was in investment mode and the payout ratio used to be 20-30%. But eventually post FY 17-18, almost all the large IT companies have moved into a high payout ratio of 80, 90, 100%. And we just shown TCS has paid out 45,000 crores of dividend payout and buyback where they generated only 42, right? Clearly, they're paying more than what they are earning for the year. So clearly, it is also reflecting in the free cash flow yield, which has grown significantly. So in our view, if you have to look at from a free cash flow yield point of view, IT can trade at one of the cheapest level, and that will give us a very good window over next 6 months to accumulate if you have a 3-4 years horizon. Because clearly, once the world economy stabilizes and start growing back, right, that will get reflected both in the IT perspective. Moving on to next. Having seen all the four, right, in terms of to summarize the entire perspective, I think RBI is not going to apply enough brakes. They have applied enough brakes on the growth. I think this is going to be growth positive in the medium term. Valuations have become very palatable and corporate India has started delivering. And we are seeing a very strong uptick both on the real estate side as well as the corporate capex side, right, which is a medium term very, very positive. So I think as an economy is in a good wicket, obviously, it will come with its bumps, right, in terms of there could be some slowdown in the near term, very expected because the world is going to slow down, primarily due to some shock which the Western worlds are seeing in banks, which will put their credit cycle tightening and that will have a multiplier effect on their growth, which will also get reflected in the economy. We cannot avoid a bit of a loss of momentum, but still we have to understand the world is doing 3% at max and we are doing 6 to 7, right? Like 2 times above. And this is not only for FY24, it's going to be FY25, 26, 27, 28, 29, 30, right? Broadly, if you take a 6-7 year perspective, right, one of the strongest world economy from a growth, from stability is going to be India, right? So I think that's where the big positive. But any equity investor has to come with minimum 4 years view, and keeping volatility is a part and parcel. And if you have that perspective, I think it's a fantastic phase to deploy capital next over 1 year period. I'll tie all that to our investment philosophy, and then I'll ask my colleague Ganesh to speak a little bit on how we are positioned in one of our product. Moving on to the next slide. As a house, our philosophy is simple in terms of we clearly think equity is a long-term asset, and we continue to take all our decision keeping long-term in perspective. We have institutionalized the decision in such a way where a lot of today our decision is between FY 26, 27. Clearly, we are seeing how much in 3-4 years we can make money, and that's where our decision is centrally focusing there. And we think clearly India is in a very bright spot. As a house, again, our general way of investing is non-consensus. We try to seek value where current temporary problem, but there is structurally a growth curve, right? So you always have to buy somewhere the consensus is not great and still, but over a period you can compound capital between 10 to 15 to 20%. So we typically not buy momentum stocks. Third, it's truly a bottom up, even though we end up seeing this macro of what's policy is doing growth. Our approach to investing is very simple in terms of as long as you find a great industry and great entrepreneur and great structure of the business where the consumers are loving the product and the business is profitable, have enough growth drivers and valuations are comfortable, right? We continue to go completely bottom up in terms of investing. And finally, as a capital allocator, the one thing is India is a growth economy, right? So growth will take care of a lot of problems. We have to measure the risk, right? So our primary job is to control the risk. The two way we control the risk. One, we try to take businesses which are very, very efficient, which is consumer friendly, so that we don't end up buying an inferior business. That's one way. Second, how much weightage we give and how much value we pay, right? So we try to control the risk from our end so that from an investing point, it's all about control the risk so that you end up rewarding much better over a period of time. With this, I will invite my colleague Ganesh to talk how one of our large cap fund, which is called TRUBLU, which is a purest 100% large cap fund, is positioned to capture this entire growth, and then we will take the Q&A. Thank you. Over to you, Ganesh.
Thank you, sir. Good afternoon, everyone. Thank you for joining us today on a Saturday morning. I know it's not easy being the IPL season and being a long weekend after the Tamil New Year. So thank you all. And as Mr. Balaji had elaborated in the since the first slide, right? How are we capturing the India growth story? We have seen India is growing, and India is growing at the right valuations right now, where it, from a 3 to 5 year point of view, it is definitely beneficial for us to be positive on India. But how do we capture this? No, obviously you're going to have multiple companies play the India growth story, but then it is increasingly important for you to be bottom up, as we have seen in the initial slide, so that you get you maximize your benefit out of the growth story of India. How you do it is by sticking to the global champions. So TRUBLU, as such, is a product which has been devised by the ithought house to give you a portfolio of global champions, right? Of champions which are pushing the India growth story forward, where you can also go along with them and take part in it. How do you take part in it? Let's see. This is just the USP of TRUBLU. What does TRUBLU actually mean? It gives you a 100% pure large cap portfolio. So if you look at portfolios which are usually called large cap, right? You would have a mix of mid cap or small cap allocated to the overall portfolio. But then with TRUBLU, what you are getting is a 100% pure large cap story. So we stay true to what our label tells us, right? Tells the society, right? It's a 100% pure large cap, and it is a high active share portfolio. So when we say high active share portfolio, what we mean is it is, you need to know how much of each of your share or each of your portion of your portfolio attributes to the overall performance of the portfolio. That doesn't make sense if your portfolio's active shares have an active share of less than 1% or 0.5%, which do not effectively do anything to the overall portfolio performance. So the attribution is something that we take very, very seriously. So you predominantly get a concentrated portfolio of 18 to 20 stocks, which are 100% pure large caps. And obviously, it's going to be a low churn portfolio. We are going to buy and hold. We are not, as Mr. Balaji had elaborated, we are not into the business of momentum or trading or short term, which is where, and our forte is predominantly into buy and hold strategies. So your portfolio will have a low churn and zero fixed fee. So we have recently introduced another option for a fixed fee as well. But then this overall portfolio has been devised with the intent of giving you the 6% free. Basically, the average inflation rate of India, which is around 5 to 6%. Once we perform that, right, beyond that, only if we perform, we would be charging you a fee on the portfolio. So the intention is to give that 6% to the investor free of cost and then charge for the remaining performance that we make on the portfolio. And now we get on to what makes a great investment. Obviously, if you look at a great investment, right, it cannot have just a strong fundamental structure, but not a fair valuation. So what we have seen in the past is that high quality companies or blue chip companies, supposedly blue chip companies, which have strong fundamentals, right? Though they have very strong fundamentals, they might be the best companies that India has to offer. But then if you do not purchase them at the right valuations, right, you do not end up making money as an investor over the long term. We have seen this time and again where buy at any price investing does not work. So where we see it is we need to have a company which is a great investment, which should have strong fundamentals plus attractive valuation. So I have to tick off the first 5 points in this checklist, and then we will have to get to a company which has strong fundamentals, and that is not enough. We will have to buy the company at the right valuation. Now let's look at each of these checklist points one by one. So the checklist number one, point number one goes to corporate governance, right? See, this is the first and foremost checklist point that we clarify with the company's fundamentals before we get onto it into our investment pipe. It has to definitely have good corporate governance and management, right? So what we have seen in the past is things may look very, very good on numbers with respect to Excel sheets, with respect to how their growth is being positioned and all that. But then if the overall corporate governance is dicey, if the management is a little dicey with respect to its response to small shareholders and with respect to statutory requirements and all that, it takes a beating on the corporate governance, and obviously market doesn't give the respect the company the valuations that it has to. I mean, rightly so, because markets, there is no valuation tool which is above, or there is no valuation perspective which is goes above the markets, right? So the markets, they tend to give valuations, the right kind of valuations or good valuations or rich valuations only to those companies which score high on corporate governance, right? So moving on from corporate governance, what we need to see is a strong leadership team with a track record of execution. See, sticking to the or tying it to the previous point, you can have everything on paper, you can have everything which is quantitative, but let's say we do not have a leadership team or a management to execute this whatever they have said on paper. So usually what we tend to look at are conservative managements who do not promise much but still outperform, right? So those are the kind of managements that we tend to stick around with, primarily because markets always look at these managements with a notch higher than the other companies which are prevailing in the market. And as always, we need to look at industry leaders in the market, right? Primarily because their industry leaders would have robust cash flows and they would have pricing power to sustain in a very tight environment like this, right? See, let's say you look at a company which is operating in an environment like today, where interest rates are being tightened, where doing business is a little bit more, it's a little harder than it was yesterday. So if you have an industrial industry leadership status which gives you pricing power, and you have a management which has looked at multiple market scenarios to lead to this industry leadership, then you get a company which is of high quality. That is the primary motive behind choosing market leaders or industry leaders in the portfolio. And obviously, if you're industry leaders, you'll have to go and you'll have to look at industries which have high growth metrics and which will grow in the future. We wouldn't be looking at companies which ideally have grown in the past, where the future growth prospects are bleak. The intention is to get into high ROCE generating companies where the expected ROCE in the next 3 to 5 years is expected to be robust, or which is expected to deliver a little bit better return than the overall corporate India return, which is around 10 to 12%. Our intention is to find or figure out companies which grow a little bit higher than the overall corporate India return to make sure that you're always on the edge with respect to your portfolio. And your companies will have zero or low leverage, except for financial companies, obviously, where the leverage is the raw material ultimately. And obviously, once the top 5 points of the checklist are ticked out, we need to look at if the company is trading at a reasonable valuation. Why this is important is we would have seen this example in the case of Walmart in one of our previous presentations, where if you look at the 50-year track record of the company, right? If you look at the last 22 years of the 50-year, the company would have gone nowhere. But then if you look at the financial performance of the company, it would have still grown at 6-7%, which is much better than the overall global growth. But still, if you look at its CAGR in terms of price, it would have grown probably at 2 to 3%, which is not something that you would expect from a global behemoth like Walmart. So it becomes increasingly important for you to figure out the right company and also invest into it at the right valuation. Now let's look at the few portfolio quants which makes TRUBLU the portfolio that it is. If you look at the 4 pillars of TRUBLU, it is structured very neatly into 4 different aspects of what it takes to build a TRUBLU portfolio, which is your portfolio construction, right? The first and foremost point that usually people tend to miss is, we have blue chip companies. Why not invest into them? It's pretty easy for us to invest into a few blue chip companies and make money, but it is not so, right? We have seen blue chip companies like or supposedly blue chip companies like Yes Bank or MTNL or DHFL going bust. So your portfolio construction has to have an adequate allocation, or rather the appropriate allocation that each company based on its quality, which comes to the next point, deserves, right? Your portfolio construction and quality, it depends on the conviction that you have on each portfolio stock that you construct the portfolio with. So once you move on from the portfolio construction, you move on to quality. Yeah, the TRUBLU portfolio is definitely going to have companies which are of high quality, of high profitability ratios, and the intention is to weed off these failures in terms of fundamentals, right? We can look at companies which are supposedly blue chips, which have dicey fundamentals even today, right? Which is completely avoided by the TRUBLU portfolio. And obviously, it has to have a highly profitable. Your TRUBLU portfolio is going to be highly profitable in nature, and and this profitability needs to be sustained, right? It is not going to be a factor only a factor of the past. We will definitely have to see how it has grown in the past, but then the profitability has to also sustain in the future, which is over a period of 3 to 5 years, which is our intended portfolio holding period, right? And with all profitability, growth is also something that the market values. So if the market doesn't get growth from a company, right, obviously it is not going to give the valuations that we expect from the company in terms of fundamentals. So growth is an important aspect of TRUBLU. Once again, of all these put together is what your TRUBLU portfolio will consist of. So what you're ideally getting is a highly profitable, high quality, large cap portfolio with adequate portfolio construction. When we say portfolio construction, it depends on how we construct, how we deploy the money as well, right? So once you give us the required initial amount, we will not go ahead and buy all the stocks which are in the pipeline at once, right? It's going to be gradual. Our deployment is going to be gradual based on the valuations prevailing at the time of entry of each investor. So all this put together, you get a high quality portfolio, which is unique and customized according to your time of entry. If you look at TRUBLU, as the label says, right, it's going to be 100% large cap portfolio of 20 stocks. So it's going to be a concentrated large cap portfolio of 20 stocks where the attribution is very, very clear, right? So we have the attribution is, if you look at our top 10 holdings, right, they have around 71% of allocation to the overall portfolio ultimately, right? So what you are essentially getting is a high conviction portfolio, or a high quality and high concentrated large cap portfolio, which for which you need to give around 3 to 5 years for it to perform and show you the results. If you look at the balance sheet quality of TrueBlue, right, it is very well spread out. We have companies in the auto sector, we have companies in the FMCG, we have companies in IT, pharma, insurance, and banking, and NBFC. So if you look at the quality of each of these companies, right, you can see that they are very high growing companies in terms of return ratios and in terms of debt equity. Also, if you look at companies which, I mean, obviously, which are not NBFC or banking companies, those are going to be very low and they are going to hold on to low leverage. We are going to hold on to low leverage, high quality companies, even in those sectors ultimately. If you look at our banking and NBFC allocation, we are pretty heavy on HDFC Bank and HDFC and a few companies, which ideally we believe that capture the India. So as Mr. Balaji had elaborated in one of the previous slides, right, we can look at HDFC Bank, which is one of the, or which is the biggest private banker in India, which is growing at an exorbitant rate even today, primarily, which suggests that they are gaining market share. And also with these valuations, we believe that HDFC Bank and other NBFC stocks that we hold in our TrueBlue portfolio have a long way to go in terms of growth. And if you look at Nifty and compare that to our TrueBlue portfolio, right? If you look at the Nifty 50, Nifty 500 stocks, which has 500 stocks, out of which 4% will be your TrueBlue, which is 20 stocks. They contribute to around 22% of the overall profits. So this is the number which is of FY 2022. So they've contributed, there is 4% of stocks contributing to 22% of the overall profits of the Nifty 500. So what you essentially get is a high profitable portfolio within the Nifty 500 universe, which are high growth and large caps essentially ultimately. So you're in a way playing the India growth story with the best companies in India through your TrueBlue portfolio, and you're doing it in a very, very concentrated way. And if you look at growth, like we saw in the first few slides, where the important pillars of TrueBlue is definitely growth. It's for you to look at how these companies have grown, right, in terms of profitability in the past. If you look at HDFC Bank, the profit ranking in the NSE 500 in 2012 was 13. Now it has gone up 8 places to number 5 in 2022. So what you're essentially getting is a portfolio of winners who keep growing, right? So the growth is not going to be stagnant, and the growth is not a factor of the past ultimately, right? So you have seen that time and again, these companies have made sure that their profits are growing much faster than the overall GDP growth. And also, if you look at the profit ranking relative, because profit is always going to be relative, right? So if you look at their relative status in the profit ranking, they have always gone up. Other 75% of your portfolio has always been on the top with respect to profit growth. So in effect, you're getting a high growth, highly profitable company, a highly profitable portfolio for you to hold on comfortably for a period of 3 to 5 years. And now we've looked at what blue chips mean, right? Because we know that blue chips usually, even if they some companies are called blue chips, they do not give out whatever is expected out of a blue chip. But then there have been companies which have time and again proved that they are true blue chips, right? You know, these are the companies that will form part of your true blue portfolio. And let's look at a couple of companies which are which will be part of your true blue portfolio and how they have created wealth in the past. And if you look at HDFC Bank, which is our TrueBlue champ, one of the TrueBlue champs, its book value over a 10-year period has compounded by 21%, right? And its share price, it's not very far, it's around 17 to 18%. What this predominantly means is that when the fundamentals come, the price is definitely going to follow, right? If you look at the share price, how it is moved up or how it is actually fluctuated over a period of time. Let's take the example between December 2019 to December 2020. If you were able to capture that gap, right, between 19 to 20, where the gap between the book value, which is the orange line, and the share price, which is the blue line, if you're able to capture the stock during that period, right, you're done, right? You are still getting a company which will compound your money at 16, 17%. You just have to wait for the company to come at a favorable valuation to you and then pick it up. And these are and these are companies with, these are large cap companies effectively, right? So liquidity definitely will not be a problem. You just have to wait it out and wait for the right time with the cash. to make sure that you deploy the money into these high quality companies at the right time. So that is simply what this bank has shown time and again, right? What this bank has shown time and again is that, even though the market tends to give knee-jerk reactions to short-term news and short-term data, right? What the bank has again and again shown that growth is something that it is very, very clear about. In despite a lot of management changes, despite a lot of issues that the company has recently faced, the company is still delivering numbers, on high double digit, which clearly states that the company is very, very focused on growth and it is also gaining market share. So that, in effect, is what TrueBlue is all about, right? It is about capturing these kind of companies. If you look at the next slide, we will also show how this has been captured in HDFC Bank over a period of, let's say, 14, 15 years, right? If you look at from 2022, what it has managed to do is it has managed to convert its entire financial year earnings into a quarterly earning in a span of 5 to 6 years. We've seen this time and again. If you take the example of FY 2022, right? FY 2022, the financial year profit of HDFC Bank was around 300 crores. And 6 years later or 5 years later, the quarter three of 2007, FY 2007, the bank had managed to match its earnings of FY 2022 in a single quarter. And this was one of the times that it had done that. And it was, and if you look at 2000, the most recent one, right? If you look at Q3 FY23 versus the FY16 number, right? The same thing has happened. And this is not the first time or the last time. We are very sure that the company is going to be doing this time and again, primarily because what we are getting with HDFC Bank is an execution machine, right? Where it manages to convert its financial year profits into quarterly profits over a period of 5, 6 years. And this has been this data is something which is very, very interesting from an execution point of view, because HDFC Bank is something that is not that has been consistent with this kind of number. You can see the numbers for your reference, right? If you look at FY 2007 versus 2012 Q2 and FY 2008 versus Q2 FY 2013, every 5, 6 years you can see that the numbers are robust with respect to HDFC Bank. And this is definitely not the last time, is what we would say. And this is not the first time that it has done this also. You can see the past, and we are very sure this is not going to be the last time as well. And now if we have to move on to another TrueBlue champ, right, we will be looking at TCS Limited, which was also covered by Mr. Balaji in one of the previous slides. So he had spoken about how in quarter four, the company, or rather in 2023, it had made 42,000 crores of profit, but it has paid out around 45,000 crores to its shareholders, right? So look at the kind of cash flows that it generates, or the kind of confidence that it has on its cash flows, that to pay out a number which is much bigger than its profit number, right? So it has actually done 42,000 crores as a PAT number and paid out 45,000 crores, which is more than 100% payout, right? So if you look at the capital which was raised initially by TCS, right, it's a very, very small number. It's around 2,000 crores. If you look at the cash flows that it has generated over a period of 18 years, it is around 2.76 lakhs crores, which is a huge number from the initial meager amount that it has garnered, which is around 2,000 crores. What this gives you is another TrueBlue champ, which compounds, which tends to grow on a very, very consistent basis. On if you have to play the IT cycle in India, right? Where else do you need to look at it except TCS Limited, which has always been a cash generating machine, right? So we've always called TCS Limited as a decadal stock. That is something stock that you can hold for more than 10 years, right? So that is what has been reflected. That is what reflects in its free cash flows and the way it has grown in the past. And we believe that at the current valuation, we still are buying TCS. We still believe that this company has a long way to go with respect to India growth story, and it will be a huge part of the India growth story, is what we firmly believe in. And just a quick results scorecard of December 2022. For March, the results have not come out for all the companies, which is why we're going with December 2022's results. So this will give you a good picture of how your portfolio is constructed and the results of, because as investors, right, our intention is to maintain the idea after we bring it to your portfolio as well, because it's not about just idea generation, is about maintenance as well. So our analysts, what they do is a very, very they have a strong vigil on the results and the performance of each of our stocks in our portfolio, be it TrueBlue, be it Solitaire, or any other product or any other scheme in our universe. They are very, very strong, and they have a strong vigil on how each company or each industry is performing across different quarters, right? So we will look at the latest numbers that have come out with respect to the TrueBlue portfolio in terms of quarterly results, that is for December 2022. If you look at the top 10 stocks of TrueBlue, right, what we can see is the companies which have grown their sales. And if you look at the not only the year-on-year change, right, if you look at the 3-year change also, they have delivered around 12 to 13% in terms of sales and PAT. So what we are essentially getting is not companies which are just growing on a low base effect just for just between quarter to quarter, and but also companies which have predominantly grown consistently over a period of 3 years. The 3-year CAGR is around 12 to 13%, which essentially means that you have exactly captured a company or portfolio which has delivered the performance that overall corporate India and around 200 basis points above corporate India's growth, basically, right? When corporate India is actually growing its earnings by around 11%, you have a company or you have a portfolio which has the top 10 stocks which have delivered 200, 300 basis points above the corporate India growth. So that is what TrueBlue intends to capture, right? It intends to capture the highly profitable, the good portion of the highly profitable companies in the overall universe and bring it to you at the right valuations, right? Once we figure out what these companies are, well, our job is pretty simple with respect to deployment. So what happens is we just need to make sure that from 9:15 to 3:30, we are on the job with respect to deployment. And once the capital comes in, it is on us to actually buy the stocks at the right price for you and sit it out. It makes it very simple. But then the due diligence that goes on behind choosing the right stocks is a little. That's where we come in, right? Ultimately, we won't know which one would turn into an MTNL or a DHFL tomorrow. So which is where our due diligence comes into picture. And once we do that, it's a pretty simple process for us, but it becomes important. The most important process or the most important point in this case is our deployment, right? We need to make sure that these companies are, whenever there is a short-term downfall, right? Whenever there is a short-term knee-jerk reaction from the markets, you will get these companies at very good valuations, right? If we look at ITC also, for that matter, in 2020, I mean, it was a blind call, right? Around 180, 190 is a pretty much give away with respect to a company like ITC Limited. So we just need to be confident about the company's fundamentals and confident about our due diligence and research and make sure that we deploy money at the right time. And this is the summary of the TrueBlue portfolio and the total 20 companies average. If you look at it, they've grown on average of 20%. EBITDA has grown at 19% and PAT has grown at 21%. So what you're essentially getting is a portfolio of high quality, high growth companies which are 5-star rated, right? We rate our companies. Our internal research process also rates the results of each of our companies that we have in our investment pipe, and they definitely have cleared all rounds on. They've gone guns blazing and they fired on all cylinders. That is what the year-on-year growth looks like for our TrueBlue portfolio. On fundamental level, this is a portfolio that cannot fail ultimately. And this is our TRUBLU Promise. So we are going to be buying highly scalable and high quality blue chips, and not blue chips just for the sake of it. It's blue chips in the true sense. They're going to be highly profitable and they are going to ensure long-term wealth creation, right? Because short-term you might have moves here and there, and whether these moves will actually sustain or will they create wealth in your portfolio is a big question, because nobody has actually made tons of wealth in the short term. It is always the long term which is going to bring you wealth which is sustainable over a period of time. And the product suitability, it is for first time investors and where you can keep your retirement corpus also parked. And if you look at big money, right, if you have family offices which can actually subscribe to a portfolio, which are ideally, there are family offices which are pretty strict about where they invest into, right? They only invest into blue chip companies or large cap companies. So predominantly family offices, we do cater to higher growth, higher ticket size family office requirement and institutional investors. So if you look at product suitability, right, it essentially gives you a portfolio which is preferred by investors who want to park their retirement corpus or who want to sustainably build wealth over a period of time. So that essentially is what TRUBLU is all about. It is not about short term. It is not about making the biggest returns in the market. It is about sustainably making decent returns over a period of time. That is what TRUBLU is all about. And why you should own a TRUBLU, it's very, very simple. It's a no-brainer decision, right? It's going to be a resilient, high-quality portfolio, which should definitely be a part of your core wealth chest, right? Let's say you have a core wealth chest as part of your overall holdings. You definitely need to have TRUBLU as a part of it, because what you are getting is ideally a debt-like, high-quality equity portfolio, which will compound your money sustainably over a period of 3 to 5 years. And this is the fact sheet for March 2023. We have our fund managers, Mr. Shyam and Mr. GR Balaji, who is the co-fund manager of TRUBLU. And currently our AUM is around 25 crores. It's a complete large cap portfolio. And as I said, it's a concentrated portfolio, which is of 20 stocks. And we currently have around 6% of cash. And the top 10 holdings, as we would have seen, it's around 71%. And if you look at the beta of this portfolio, right, it's a 0.72, which is one of the lowest in the industry, because what you are essentially getting is a portfolio of stocks which have low volatility when compared to the market. So you tend to have better sleep when you own a TRUBLU portfolio, because what you're essentially getting is a portfolio of high quality growth stocks bought at good valuation, so that your margin of safety is definitely protected. And just a look at our investment team. We have Mr. Shyam, who has around 3 decades of experience in the markets, and we have Mr. Balaji also, who's been with Fidelity, Reliance Capital, IFL Wealth, and he has over 15, 16, 17 years of experience in the financial markets. So what we have is a very strong fund management team, which is managing your TRUBLU portfolio. So what comes with this is years of experience, is the qualitative, right? Because certain things we can put on paper, we can do with certain analysts, but what you are essentially getting on the qualitative side is about avoiding traps like Yes Bank or a DHFL. That is where our fund management experience, or the cycles, we have fund managers who withstood multiple cycles in the markets, which out of their experience, they can contribute a lot more than just numbers in the overall portfolio construction, right? So with that, we also have a very, very strong research team with CFAs, CAs. We have strategy team, and we have a clear segregation of functions with respect to our jobs, right? We also have Mr. Rohit and Rajat managing our small cap fund. We have Mr. Niranjan managing our multi-asset fund, which is he's the head of investment strategy as well. So we have Mr. Balaji at the top, which is the head of research and the co-fund manager of TRUBLU. So what we are essentially getting is not a 1% or a 2% job, which is done, which will actually carry out functions in your portfolio, because your portfolio is constructed with a lot of bottom-up approach, right? Because it's not going to be a top-down approach where it's going to be just one model portfolio and the same thing is going to be replicated for all our investors. So it's a process. And to carry out these processes, we have a very, very robust team across functions where there is a clear segregation of functions, right? So you are getting a portfolio which is managed very well and very robustly through robust process and robust functions. And our latest portfolio performance, which is as of 31st March of 2023. And if you look at the 1 year numbers, where the Nifty 50 has actually been flat, we've been able to do an 8% return net of fees and charges. So what this essentially means is our portfolio construction also comes a lot into play in this case, right? Because we wouldn't be buying a company when it is actually appreciated, or rather when it goes beyond its intrinsic value, right? We would be buying a company gradually. If you had looked at our initial deployment phase, right, of TRUBLU portfolio, we would have deployed the money very, very gradually, because when we started off, which is around March 2021, and September, the markets hit a peak, right? So we had to get gradual with our deployment at that point of time. So if you looked at the valuations at that point of time, it made sense for us to hold on to cash and then gradually deploy. But then we were able to find out certain pockets of value in the market even at that point of time to deploy cash into, where we had deployed that portion of cash, and remaining was kept in a liquid fund for us to invest further when the opportunities came, which is where the performance has actually come from. And our since inception number is 5 to 5 matches with Nifty 50. But then you can see that the 1 year performance, where the markets have actually not performed, we have tend to perform. tended to perform better, or around our 8% and 9% is our outperformance against the markets. So this needs. If you look at, if you give this TRUBLU portfolio a couple of years or 3 to 5 years, right, you would see you would get the intended returns that the TRUBLU portfolio promises ultimately. So that is what TRUBLU is all about. And the key terms, we have two options actually. So there's no exit load in this portfolio. The minimum investment for a PMS is as such, as per SEBI regulations, is 50 lakhs. And we have two fee options with this portfolio, which is a zero fixed fee plus, or rather, there's no fixed fees and performance fees of 20% over a hurdle of 6% with no catch up. Or you can go for a fixed fee, like saying, you know, I'm not going to pay a performance fees of, if you're not comfortable with paying a performance fee, you can go for the option of paying a fixed fee, which is at 1%, right? So I'll just give you all a minute to go through the terms, before which I'll move on to the next slide. Okay, I'll move on. And so we've come to the end of the presentation, and thank you all for joining us today. And it was great. Again, Saturday morning, it's definitely not easy because it's a holiday season. It makes sense for us to actually have a quick brunch and go off to sleep, what we all would be expecting on a Saturday morning. But then thank you all for joining us today, and we'd be happy to answer any questions if at all there is any. Thank you. I'll just move on to the first page so that you can take a look at our contact numbers as well, so that you can reach out to us in case you are interested in our product. Thank you. Now the floor is open for questions. You can type in your questions in the chat box. So your chat box is on the top left of your screen, which is close to the timer, which is right next to the timer. So if you click on that tab, and then your comment box will open where you can type in your questions. Any questions from the YouTube live chat also can be specified on this chat box so that we can answer it over here. And the communication team can just put those questions on this chat box so that we can answer it over here. Poonam,
Yes,
any
Ganesh,
questions
we'll
from the
share it.
YouTube live? Yeah.
Not yet, but we'll
Okay.
share it as they come up.
Sure, sure. Thanks.
Ganesh, I think we can.
Okay, sir. So
I think thanks all
yes,
for joining. And any questions, we'll be able to happy to answer you. Thank you.
yes, sir. Thank you, everyone. Thank you, thank you, thank you, sir.